Hello everyone, and welcome back to the channel. Today, we're diving deep into the recent market movements. Specifically what happened this past Friday and what it signals for the week ahead. For your portfolio, and even for the broader economy. It was a roller coaster of a week, and Friday's session added another interesting twist. So, grab your coffee, and let's break it down. On the surface, Friday looked like a good day. The S&P 500 climbed about 0.8%, the Dow Jones Industrial Average added a solid 1.5%, and the tech-heavy Nasdaq Composite edged up by a sliver, just 0.01%. A win is a win, right? Well, it's a bit more complicated than that. Despite these gains, all three major indexes ended the week in the red. The S&P 500 was down 0.5% for the week, the Dow dipped 0.2%, and the Nasdaq took the biggest hit, dropping 1.1%. This tells us that the optimism on Friday wasn't quite enough to undo the damage from earlier in the week. So, what drove this Friday rally? And why wasn't it stronger? A big piece of the puzzle is the latest economic data, specifically the jobs report. The numbers came in softer than expected. The U.S. economy added 175,000 jobs in April, which sounds like a lot, but it was well below the 240,000 economists were predicting. At the same time, the unemployment rate ticked up slightly to 3.9%, and wage growth slowed down. Average hourly earnings rose 0.2% for the month and 3.9% over the year, both less than anticipated. Now, you might think, wait, a weaker job market? Isn't that bad news? And for the people affected, it certainly can be. But from a market perspective, this was actually seen as good news. Why? It all comes down to the Federal Reserve and interest rates. For months, the market has been worried about stubborn inflation and a too-hot economy, which would force the Fed to keep interest rates higher for longer. Higher rates make borrowing more expensive for companies and consumers, which can slow down economic growth and hurt stock prices. This softer jobs report flipped the script. It suggests that the economy might be cooling down just enough to ease inflationary pressures. It's the Goldilocks scenario the market has been hoping for. Not too hot, not too cold, but just right. This renewed optimism that the Fed might actually be able to cut interest rates later this year. In fact, after the report, traders increased their bets on a rate cut happening as soon as September. Fed Chair Jerome Powell had already eased some fears earlier in the week by saying that the next move was unlikely to be a rate hike, and this jobs data seemed to confirm that the pressure is easing. This interest rate sensitivity was clearly visible in the bond market. The yield on the 10-year Treasury note, which is a key benchmark for borrowing costs, fell sharply after the jobs report was released. When yields fall, it's generally good for stocks, especially growth-oriented sectors. Let's look at how different parts of the market reacted. The Dow's strong performance was largely thanks to a massive surge in Amgen stock, which soared nearly 12%. This came after the company reported very promising results for its experimental weight loss drug. Investors are seeing a huge market for these types of treatments. And Amgen just threw its hat into the ring as a serious contender against giants like Eli Lilly and Novo Nordisk. This single stock had a huge impact on the Dow's overall performance. Another big winner was Apple. The tech giant reported earnings that beat expectations and, more importantly, announced the largest stock buyback program in U.S. history, a staggering $110 billion. A buyback is when a company uses its cash to buy its own shares from the market, which reduces the number of shares outstanding and can boost the stock price. This move signaled massive confidence from Apple's management in their own company's future value, and investors loved it. Apple's stock jumped about 6% on the news. However, the tech sector as a whole, represented by the Nasdaq, was much more subdued. Why the tiny gain when its biggest component, Apple, had such a great day? It's because other areas of tech and growth stocks faced headwinds. Companies like Coinbase, the cryptocurrency exchange, saw their stock tumble after reporting a loss despite a surge in trading revenue. This highlights the volatility in the crypto space. Similarly, Expedia, the travel booking company, saw its stock plummet over 15% after it cut its full-year guidance, citing slowing travel demand. This creates a fascinating picture of the current market. We're not seeing a broad, everything goes up kind of rally. Instead, it's a very selective stock pickers market. You have individual companies like Amgen and Apple soaring on company-specific news, while others like Expedia are getting punished for signs of weakness. This divergence shows that investors are becoming much more discerning. They're not just buying tech or growth as a category, they're digging into the fundamentals of each individual business. So what does this all mean for you and your money? First, it's a reminder that economic data moves markets in powerful and sometimes counterintuitive ways. A bad jobs report can be good for stocks if it means lower interest rates are on the horizon. This is the complex dance between the economy and Wall Street. Second, the theme of a stock picker's market is crucial. The days of simply buying an index fund and watching it go straight up might be on pause. Now, more than ever, it's about identifying quality companies with strong balance sheets, clear growth catalysts, and resilient business models. The massive reactions to earnings reports from Apple and Expedia prove that individual company performance is what's driving major stock moves right now. Third, what's the outlook for the coming week? The market will be closely watching for more clues on inflation, and the Fed's thinking, we'll be getting more inflation data in the coming weeks. And every piece of information will be scrutinized for hints about the timing of that first potential rate cut. The narrative has shifted from when will the Fed cut to will the Fed cut at all this year? And now, back to, okay, a cut is likely, but expect this spoken forth to continue, bringing with it more market volatility. For society at large, the jobs report offers a mixed bag. On one hand, a cooling labor market might be exactly what the Fed needs to see to get inflation under control without causing a major recession of a so-called soft landing. This would be a great outcome for everyone, preserving jobs while stabilizing prices. On the other hand, a slower pace of hiring and a rising unemployment rate, even a slight one, means real people are having a harder time finding work. It's a delicate balance, and the Fed is walking a tightrope. The slowdown in wage growth is also a double-edged sword. It helps fight inflation, but it also means people's paychecks aren't growing as fast to keep up with the cost of living. So, to wrap it all up, last week was a microcosm of the current market environment. We saw a Friday rally fueled by hopes of Fed rate cuts after a weaker-than-expected jobs report. However, this optimism wasn't enough to erase earlier losses, and the market remains choppy and selective. Big corporate news, like Apple's buyback and Amgen's drug trial, is creating huge winners, while disappointing outlooks are leading to big losers. As we move forward, keep your eye on the big picture, the path of inflation, and the Federal Reserve's response. But also, pay attention to the details, the individual company, earnings, and stories that are making or breaking stock performances. It's a complex environment, but understanding these dynamics is key to navigating it successfully. Thanks for tuning in today. I hope this breakdown was helpful for you. If you've got some value from this video, please hit that like button and consider subscribing for more deep dives into the markets and the economy. Let me know your thoughts in the comments below. What are you watching in the week ahead? Until next time, stay informed and invest wisely.